In 1929, a man named Jesse Livermore made $100 million shorting the stock market crash. He saw it coming when everyone else was buying. He understood the pattern. By 1940, he was dead by his own hand, broke and forgotten. His fortune evaporated in the years that followed. The people who survived the Great Depression spent the rest of their lives warning the next generation. They told their children never to trust banks completely, never to leverage everything, never to believe the market only goes up. Those children grew up, prospered in the post-war boom, and mostly ignored the warnings. They told their own children that the old fears were outdated. Then came 2008. Millions lost homes, retirement accounts vanished, and suddenly the old warnings didn't sound so paranoid anymore. The survivors of 2008 are now telling anyone who will listen that the same conditions are building again. Shadow banking leverage, AI speculation replacing housing speculation, retail investors being fed complex derivatives through apps designed like slot machines. Every generation watches the previous one suffer through a crash, learns the lessons, passes on the warnings, and then the next generation ignores them completely. The pattern isn't hidden. It's been documented for a century, but collective memory lasts about 30 years before optimism erases caution and the cycle begins again. The Great Depression created a generation that never forgot. They lived through bank runs, breadlines, and watching neighbors lose everything overnight. These people developed financial habits that seemed extreme to those who came after. They buried cash in backyards, refused to invest in stocks, kept multiple bank accounts with small balances spread across institutions. Their children found these behaviors irrational, the product of trauma rather than wisdom. But the behaviors were based on lived experience, not irrational fear. One woman interviewed in the 1970s described how her father, who lost his hardware store in 1931, spent the rest of his life maintaining a secret cash reserve in the basement. He never told his wife the full amount. When he died in 1965, she found over $40,000 hidden in mason jars behind the furnace. To his children, this seemed like hoarding, a psychological problem. To him, it was the lesson he learned when the bank that held his business deposits failed and he couldn't make payroll. The emotional cost of that failure shaped his relationship with money for 34 years. The Depression generation tried to pass on specific warnings. Don't buy stocks on margin. Don't trust that property values always rise. Don't assume your job is secure. Banks can fail. Governments can fail to act in time. These weren't abstract principles. They were instructions for survival based on watching half the banks in America close their doors between 1930 and 1933. Over 9,000 banks failed during that period. Families lost life savings. Businesses couldn't access capital. The entire commercial infrastructure of America seized up because the financial system collapsed under the weight of speculation and leverage that had been building throughout the 1920s. But warnings lose power when they're not attached to direct experience. The children of Depression survivors grew up in the 1950s and 1960s, decades of unprecedented growth. The economy expanded, wages rose, home ownership became accessible, and the stock market delivered consistent returns. The old warnings started to sound like the ramblings of people who couldn't adapt to modern prosperity. Young professionals in the 1960s looked at their parents' financial anxiety and saw psychological damage, not practical wisdom. They believed the New Deal reforms, deposit insurance, and modern economic management had made another depression impossible. The institutional safeguards erected after 1933 were working exactly as designed, but the success created complacency. The protections were seen as permanent features of the landscape rather than bulwarks that required constant defense against erosion. By the 1980s, the financial landscape had changed completely. Deregulation accelerated, Glass-Steagall protections began eroding through regulatory action before legislative repeal, and a new generation of bankers and investors operated without any personal memory of systemic collapse. The institutional caution that governed banking from 1933 to 1980 dissolved. The people making decisions had never seen a major crash. They treated the Depression as ancient history, irrelevant to modern risk management and sophisticated financial instruments. The regulatory agencies that were supposed to maintain vigilance were being staffed by people who viewed regulation itself as an obstacle to efficiency rather than a necessary brake on dangerous behavior. The dismantling of Depression-era safeguards followed a predictable pattern. First came the intellectual argument that old regulations were inefficient obstacles to growth. Then came lobbying from financial institutions that wanted to compete on a level playing field with less regulated entities. Then came regulatory agencies yielding to industry pressure, reinterpreting rules to allow increased risk. Finally came legislative repeal, codifying the new reality into law. The Gramm-Leach-Bliley Act of 1999 formally eliminated the wall between commercial and investment banking that Glass-Steagall had erected. This occurred at the peak of the dot-com bubble, when technology stocks were soaring based on narratives about a new economy that had transcended old limitations. The Nasdaq Composite Index rose from 1,000 in 1995 to over 5,000 by March 2000. Companies with no profits and no path to profitability commanded billion-dollar valuations. When skeptics pointed out that the fundamentals didn't support the prices, they were dismissed as relics who didn't understand the transformative nature of the internet. The phrase, "this time is different," was used to justify valuations that had no historical precedent. Alan Greenspan, then chairman of the Federal Reserve, had warned about irrational exuberance in 1996. But as the boom continued without immediate collapse, even he backed away from intervention. The market kept rising. Fortunes were made. Anyone who had sold early looked foolish. The psychological pressure to participate became overwhelming. This is how bubbles sustain themselves in the late stages. The pain of missing gains exceeds the fear of potential losses. Professional fund managers who recognized the bubble still had to stay invested because their performance was measured against benchmarks that were inflating. Sitting out meant losing clients, so even the skeptics participated, hoping to exit before the crash. The bubble burst in 2000. The Nasdaq lost 78% of its value over the next 2 years. Trillions in market capitalization evaporated. Retirement accounts that had been heavily weighted toward technology stocks collapsed. But the broader economy didn't enter depression. The Federal Reserve cut interest rates aggressively, dropping the federal funds rate from 6.5% to 1%. The crash was contained to equity markets. Housing prices kept rising. Credit remained available. The lesson many took from this episode was that modern policy tools could prevent crashes from becoming catastrophes. Central banks had learned how to manage downturns. The system was more resilient than the pessimists believed. This interpretation was catastrophically wrong. The low interest rates that cushioned the dot-com crash created the conditions for an even larger bubble in housing. Cheap credit flooded into real estate. Lending standards collapsed. Financial institutions created complex securitization structures that obscured risk while concentrating it. Mortgages were bundled into securities, sliced into tranches, and sold to investors who relied on rating agencies that fundamentally misunderstood the underlying risk. The agencies used models that assumed housing prices couldn't fall simultaneously across the country. This assumption was wrong. The models were wrong. But the fees for rating securities were enormous, and the agencies faced competitive pressure to deliver the ratings that issuers wanted. The generation of bankers and regulators in charge had no memory of the Depression, and their only recent experience of a crash was one that had been successfully managed with monetary policy. They believed the risk was under control. Data from the mid-2000s shows that regulatory staffing at key agencies had been cut to 1980s levels, even as the financial system had become exponentially more complex. The regulators were overwhelmed, underfunded, and operating under political pressure not to interfere with the housing boom. When individual regulators raised concerns about subprime lending or dangerous leverage levels, they were marginalized or removed from their positions. By 2006, multiple analysts were publishing warnings about housing market instability, dangerous levels of subprime lending, and opaque derivative products that concentrated systemic risk. These warnings came from people who had studied financial history, who understood how leverage amplifies both gains and losses, who recognized the pattern of speculation divorced from underlying value. The warnings were largely dismissed. Housing prices had risen consistently for decades in most markets. The idea that they could fall simultaneously across the country seemed implausible. Modern diversification and risk management techniques were supposed to prevent that kind of correlation. Economist Nouriel Roubini predicted the crash with remarkable specificity in 2006, describing how the housing bubble would pop, trigger mortgage defaults, and cascade through securitized products to threaten major financial institutions. He was mocked as Dr. Doom. Other skeptics who shorted the housing market were treated as paranoid or unpatriotic. The institutional consensus was that housing was sound, that subprime loans were a small segment of the market, and that the complex financial engineering had distributed risk so widely that no single point of failure could bring down the system. When Bear Stearns collapsed in March 2008, there was still institutional denial about the scale of the problem. Treasury Secretary Henry Paulson assured markets that the situation was contained. When Lehman Brothers failed in September 2008, the denial shattered. The commercial paper market froze. Credit markets seized. Banks stopped lending to each other. Money market funds, considered absolutely safe, broke the buck. The velocity of money collapsed. What followed was the worst financial crisis since the Great Depression. Housing prices fell 30% nationally. Unemployment reached 10%. Over 10 million Americans lost their homes to foreclosure. A quarter of American families saw their net worth decline by 75% or more. The survivors of 2008 experienced the same kind of trauma the Depression generation had lived through. They watched retirement savings disappear. They saw neighbors evicted. They learned that institutional stability was an illusion, that banks deemed too big to fail would be saved while homeowners drowned. Young people graduating into the crisis saw career paths collapse. Unemployment for recent graduates reached 20%. Those who found jobs took positions far below their qualifications, suffering wage penalties that would last their entire careers. The emotional damage was profound and lasting. Studies tracking millennials who entered the workforce during or after the crisis show permanently altered financial behavior. They are more conservative about debt, more skeptical about homeownership, more likely to keep significant cash reserves. They inherited the caution their great-grandparents tried to pass down, but only after experiencing the crash firsthand. The policy response to 2008 followed the post-Depression template. New regulations were enacted. Dodd-Frank created 2,300 pages of rules aimed at preventing another collapse. Stress tests were imposed on major banks. Capital requirements were increased. The Volcker Rule attempted to separate proprietary trading from commercial banking. But the same cycle that eroded Glass-Steagall began immediately. Financial institutions lobbied to weaken enforcement. Regulatory agencies, starved of resources and facing industry pressure, granted exemptions and delayed implementation. By 2018, significant portions of Dodd-Frank had been rolled back. Smaller banks were exempted from stress tests. The Volcker Rule was weakened. The memory was fading again, just 10 years after the crash. Politicians argued that the regulations were strangling economic growth, that banks needed flexibility to compete globally, that the pendulum had swung too far toward caution. The current financial landscape mirrors the pre-crash environment in specific documentable ways. Leverage is again at extreme levels, but it has migrated from traditional banks to the shadow banking system. Non-bank financial intermediaries now hold trillions in assets, operating with minimal regulatory oversight. These entities include hedge funds, private equity firms, and specialized lending platforms. They use high leverage, maintain liquidity mismatches between assets and liabilities, and are deeply interconnected with the regulated banking system. When stress hits these institutions, they don't have access to central bank emergency lending. Their response is to sell assets rapidly, which amplifies market volatility and transmits shocks throughout the system. The size of the shadow banking sector has grown exponentially. Estimates place total assets under management in non-bank financial institutions at over $20 trillion globally. These entities are linked to traditional banks through credit lines, derivative contracts, and asset holdings. A fire sale by hedge funds forced to meet margin calls would hammer asset prices, which would trigger losses at banks holding similar assets, which would tighten credit conditions, which would force more selling. The mechanics are identical to 2008, but the leverage is hidden in structures that regulators struggle to monitor. Speculation has attached itself to artificial intelligence the same way it previously attached to radio stocks in the 1920s, internet stocks in the 1990s, and housing in the 2000s. The technology is real and transformative, but the valuations being assigned to AI-related companies often disconnect from any reasonable projection of future cash flows. Companies are spending tens of billions on AI infrastructure with unclear paths to profitability. NVIDIA, the chip manufacturer at the center of the AI boom, saw its market capitalization rise from $300 billion to over $3 trillion in less than 2 years. The gains were driven by narrative and momentum as much as fundamentals. Industry leaders like Jeff Bezos and Sam Altman have explicitly warned about bubble dynamics, using language nearly identical to the skeptics who were ignored before previous crashes. Bezos called the current environment an industrial bubble. Altman predicted that people would overinvest and lose money during this phase. These are the people building the technology, and even they see speculative excess. But the warnings are again being drowned out by narratives about a new era that has transcended old limitations. Analysts publish reports explaining why traditional valuation metrics don't apply to AI companies, why the technology is so transformative that current prices will look cheap in retrospect. Retail investors are being offered complex, high-risk products through interfaces designed to maximize engagement rather than understanding. Private equity investments, once available only to institutional investors, are now being marketed to ordinary workers through 401k plans. Cryptocurrency derivatives, leveraged trading on margin, options strategies that require sophisticated risk management, all of these are accessible through smartphone apps that use the design patterns of social media and gaming. The apps track engagement metrics, optimize for time spent on platform, and use variable reward schedules to maintain user attention. Trading becomes entertainment, detached from the underlying reality of capital allocation and business valuation. The pitch is framed as democratizing finance, giving ordinary people access to the tools previously reserved for the wealthy. The reality is that complex instruments are being sold to people who don't fully understand the risk, exactly as margin accounts were sold to middle-class Americans in the 1920s. In 1929, you could buy stocks with 10% down and borrow the rest. Today, you can trade options with leverage ratios of 50-1 on a phone app while waiting for coffee. The mechanism is more sophisticated, but the underlying dynamic is identical. Retail investors are being given access to leverage and complexity at precisely the moment when professional investors are most concerned about valuation risk. The financial system benefits from generational amnesia. Each boom requires participants who believe the current expansion is sustainable and different from past bubbles. If everyone who lived through 1929 were still making investment decisions in 1999, the dot-com bubble wouldn't have inflated. If everyone who lived through 2008 were still making lending decisions in 2024, the current leverage levels wouldn't exist. But professional careers in finance typically span 30 to 40 years. The people running major financial institutions today were in entry-level positions during the 2008 crisis or entered the industry after. Their formative professional experiences occurred during the recovery, when aggressive monetary policy prevented collapse and asset prices resumed their upward trajectory. This creates institutional blindness. The current generation of financial leaders has seen crashes followed by recoveries. They've learned that central banks will intervene, that governments will provide support, that betting against the long-term upward trend of markets is a losing strategy. These lessons are correct up until the moment they're not. The pattern across 1929, 2008, and the emerging crisis isn't that crashes are unpredictable. The pattern is that crashes happen when leverage becomes unsustainable, when asset prices detach from fundamental value, and when regulatory guardrails have been systematically dismantled. These conditions are observable. They exist now. The emotional architecture of denial is also consistent. In 1929, Irving Fisher declared stock prices had reached a permanently high plateau less than a month before the crash. In 2006, Ben Bernanke testified that subprime mortgage problems would be contained. In 2024, financial analysts argue that high valuations should be accepted as the new normal because leading companies have strong balance sheets and modern risk management is superior to past generations. The specific arguments change, but the underlying psychological mechanism is identical. People in positions of authority must believe the system is stable because their positions depend on that stability. Acknowledging systemic fragility would require actions that are politically and economically unpalatable. So the fragility is denied until denial becomes impossible. The consequences of crashes are not equally distributed. The people who suffer most are those with the least ability to absorb losses. In the Depression, it was farmers and industrial workers who lost everything. In 2008, it was subprime borrowers and working-class families who had been sold mortgages they couldn't afford. The next crash will again fall hardest on those who were promised access to wealth-building tools but were actually being sold risk. They didn't understand. The moral damage from crashes exceeds the economic damage. When ordinary people watch financial institutions get bailouts while their homes are foreclosed, trust in the system collapses. When executives who oversaw systemic failure receive golden parachutes worth millions while workers lose retirement savings, the social contract fractures. The CEO of Lehman Brothers, Richard Fuld, made over $500 million in the years leading up to the collapse. He kept most of it. The janitors who cleaned Lehman's offices lost their jobs and their retirement accounts. This disparity is not accidental. It's structural. Financial systems are designed to transfer risk downward and profits upward. The Occupy Wall Street movement, the rise of populist politics across the spectrum, the widespread cynicism about institutions, all of these are downstream consequences of the perceived moral betrayal in 2008. The bailouts may have been economically necessary to prevent total collapse, but they were politically catastrophic because they rewarded failure while punishing prudence. Trust in banks fell from 49% before the crisis to 21% after. Trust in Congress dropped below 10%. Entire cohorts of young people concluded that the system was rigged, that hard work and saving were for suckers, that the only rational response was either withdrawal or rage. Generational attitudes reflect this trauma. Millennials who came of age during 2008 are more financially conservative than baby boomers who came of age during the post-war boom. They carry more cash, invest less in equities, and express profound skepticism about homeownership. But Generation Z, which has no direct memory of 2008, is already showing higher risk tolerance and greater participation in speculative markets. The cycle is reasserting itself within 15 years. Gen Z investors are 45% more likely to buy the dip and engage in frequent manual trading than older investors. They use apps that didn't exist before 2008, trade assets that didn't exist before 2008, and operate with an assumption that volatility is normal and crashes are brief. Financial crashes follow predictable timelines because they're driven by human behavior rather than random events. A crisis creates regulatory response. The regulation prevents similar crashes for approximately 60 years, which is 2 full professional generations. As the memory of the crisis fades, industry pressure erodes the regulations. New instruments and structures emerge that circumvent the remaining rules. Leverage builds in less visible parts of the system. Speculation attaches to whatever technology or asset class offers the narrative of unlimited growth. Warnings from skeptics are dismissed as failing to understand the new paradigm. Then comes the crash. We are now approximately 17 years from the 2008 crisis. The regulatory response has already been significantly weakened. Leverage in the shadow banking system has reached levels that regulators publicly acknowledge create systemic risk, but claim they lack authority to control. Speculation in AI stocks mirrors the speculation in dot-com stocks and 1920s radio stocks. Retail investors are being offered complex derivatives through gamified interfaces. The conditions are assembled. The warnings are being issued. The warnings are being ignored. The specific trigger is unknowable. In 1929, it was a series of margin calls that forced selling, which triggered more margin calls. In 2008, it was the realization that mortgage-backed securities were filled with worthless loans. The next trigger could be a geopolitical shock, a policy mistake, or simply the moment when leveraged positions become unsustainable and forced selling begins. The trigger matters less than the underlying fragility. Once the crash begins, the speed will surprise everyone who insisted it couldn't happen. The interconnections that amplify gains during the boom amplify losses during the crash. What took years to build unravels in weeks. The survivors will spend years rebuilding. They will develop cautious financial habits based on trauma. They will warn their children never to trust that asset prices always rise, never to leverage everything, never to believe this time is different. Their children will listen politely, prosper during the next boom, and mostly ignore the warnings. The pattern will continue because institutional memory is not passed genetically. Each generation must learn the lessons through direct experience, which means each generation must live through the crash.